We are live, and this is a screaming red alert buy signal. Our high risk growth portfolio returned 233% in 2021, turning every $10,000 invested into $33,000. Our strategy is up 2.7% this morning in January with our high risk growth portfolio. And right now it's so simple. There's only 3 tickers to purchase. We've got our crash insurance with UVXY. If you're putting 10,000 to work today, you'd be buying 88 shares of UVXY. Next, we're front loading the portfolio heavy in technology and our favorites, Ethereum. It's like getting into Microsoft in its infancy. Ethereum is taking the US banking and insurance and stock brokerage system and replicating it into DeFi. They are kicking ass. It's working. Hundreds of billions of dollars are stored in this technology, and it's just at the start of a beautiful, beautiful run up coming into the new merge into proof of stake. So we're extremely bullish on ETHE. You can actually get the asset at an extreme discount compared to what the trust actually owns today. Looking for a pullback in NRGU. Boy, that thing keeps squeaking a little bit higher. We took a massive gain on it, nearly called the top, but it has gone a little bit higher. We're looking to hedge against more inflation in the short term with natural gas using ticker BOIL. Now, look, we are aggressively long growth, 56%. We're protecting the growth position against probably the last 3 months of accelerating inflation with energy. And then we're going to hedge against an all-out crash with UVXY. Now, as soon as those yields fall back down and we hit some critical levels, we'll go ahead and reposition back into NRGU and take some profits on Ethereum. So you want to be following our webinars to get these buy and sell signals. Here's what's been causing all the pain. If you're long tech or crypto, you've seen the pain this year because the bond market's been crashing. When yields go up, they attract money specifically from growth assets until they become happy. So as the Fed's going to stop buying so much of our debt, yields had to rise. This move was historic over the last 2 weeks, and I think it's extremely unlikely to continue. Why? The entire global economy is slowing down. Every single metric is showing a slowdown in growth. Now, that means you want to buy the only assets that provide growth, and that's your tech giants. So now's the time to load the boat and go all in with our strategy. We believe you're going to have a beautiful return in the very, very short term. And again, NASDAQ, Bitcoin, Russell 2000, even the S&P 500 are all at critical technical levels due to this bond crash. It's over. It's time to buy the dip. Meanwhile, banks, Google, Intel, everybody is moving in on crypto. I predict we will see a $12,000 Ethereum within 24 months or less. So it's going to be a beautiful, and maybe sooner than 2 years. We will see what kind of run up we get into the summer. And realize this, if the Fed goes crazy with rate hikes, with what everybody's already priced in, again, we've already priced in 4 rate hikes. The pain is over. We're heading into midterms at the end of this year. It's extremely unlikely they're going to go create a global recession ahead of midterms. So buy the dip. Meanwhile, China is starting to lower interest rates and print money. And the best way to predict that rebound is in Alibaba. Every day US stocks are down, emerging markets are up, telling us to buy the dip. Now, in our safe growth strategy, we have a huge bet in emerging markets. It's our single largest position, and it is outperforming everything. Inflation is likely going to peak in March. Now, what's so important about March? That's the 2-year anniversary of the lockdowns. Okay, after that, the relative CPI data is likely going to stabilize and fall the rest of the year. This means the 4 rate hikes that are already priced into the market are done. We don't have to worry about any more talk of bonds crashing and rate hikes going up in the short term. Labor growth is falling, GDP predictions from the Atlanta Fed have crushed in half. Retail sales are down 2%. Okay, give me a break. Nobody's going back to work. And the new Build Back Better bill is on pause. They're not going to pass any more spending until the inflation comes down. So ignore all the chaos, get invested. This is the perfect setup. Safe growth returned 25% in 2021, up 1% this morning in January. It's been up as much as 6%. We've had a little bit of a pullback due to the bond volatility, but again, it's over in my opinion. Almost tempted to buy bonds, but I think we'll make way more money owning tech right now. So we've not made that move just yet. And you guys know I love bonds, just not yet. We need to see the CPI come down and those interest rates get closer to the inflation level. Meanwhile, our high risk strategy had as high of an 8% return as well in January, came back a little bit, but most people in January are down significantly. Our strategy protects against all risks, reduces volatility, and delivers profits. You just sit back and let things play out. Let's talk about the key macros to focus on in 2022. What if I told you this is just about the only thing that really matters for our predictions is that the debt ceiling was increased by $2.5 trillion. Okay, old Mitch McConnell gave it to the Democrats on a silver platter. He could have cornered them into a disaster, but no, no, no. Last thing they want to do is make the government default because they're all on the same team. Once you realize that, you can predict the spending will continue, and that's how we know where to place our money. This is a chart of the US government's deficit and surplus. Unless you think we're getting into a surplus where the government makes more money than it spends, we're going to have a pretty straightforward approach on how to play the markets. And guess what? They're going to spend about $2.5 trillion in the next 16 months, more than we've made. That's going to make the cost of everything go up. So now they just have to agree on how to spend it and when to spend it. And that's likely going to occur after the CPI stops going up and the price of oil comes back down. Now, meanwhile, corporations have planned trillions in stock buybacks. Doesn't even matter if retail sales slow because the number of shares outstanding are going to shrink. This makes earnings per share go up. We had a very, very disappointing December labor growth, supposed to be at 500,000 jobs, came in at 200,000. Okay, retail sales just fell 2.2%. Every data print is showing that the inflation will peak in 3 months. Growth is slowing down. The Fed's not going to go ballistic with rate hikes and quantitative tightening. Okay, it's all just forward guidance because they know if they really do it too aggressively, you create a global recession in front of midterm elections. So where else do you put your money? Cash is trash. Every government globally has a demographic problem. There's too many people to support and too few workers. So they've got to print money to keep these people even alive. This means cash is trash and probably for a very, very long time. Okay, bonds we like, but not until there's probably about another 35 to 50% puke in the TLT. And that's when I will be an aggressive buyer. I expect that to happen probably after midterms in 2023. Investors have no other logical option. That's why after you see all these weird moves, everybody goes back to the same bets. Stocks, crypto, commodities are likely to melt up, taking turns until the bond market becomes attractive. Why? There's nowhere else to put your money, and bonds need to crash, quite likely another 35 to 50% to become attractive. So what's our worst fear? Strong labor growth. Is this administration creating strong labor growth? Not yet. We've got our eye on it. So far, it's been very weak. Rising interest rates are the key threat. And again, labor market will drive that. That's not going up. Retail sales are falling. Again, interest rates fall when growth slows, and that's the environment we're heading into. So everybody's completely off. We've been betting the inflation would be hot all of 2021 and made our clients a fortune. But now we believe in the short term it's going to slow down. And this is critical for Biden to pass his Build Back Better. CPI, PPI have to stop going up and start to slowly fall so they can pass their new budget by March or April. So now, again, if it doesn't happen, I'll be wrong and quickly react, and that would likely create a stock crash. So again, watch our webinar every Monday, Wednesday, Friday, because we are on the pulse of this data, and we will get you ready for the trade alert. Now, if anything does go wrong and I've miscalculated something, our clients still don't care because we always have them hedged against a stock market crash with UVXY. And 2 years ago in the lockdown, it went up over 1,000%. Get this, if you had 10% long UVXY in the lockdown, the other 90% of your portfolio could have gone to zero and you would have been up net 10% without touching a thing. And then as the VIX came back down and your stocks came roaring back up because Powell began to print trillions of dollars, again, you saw relatively much lower volatility and ended up with much better returns. So now may be the best time ever to go all in, put your money to work. We like to put 30% of our money in the high risk growth strategy and 70% behind our safe growth. Every time your high risk goes up considerably, take profits and funnel it into your safe growth strategy. And the opposite's true. If your high risk takes a beat down and loses some money, well, you're going to pull money out of your safe growth to refill the tank. These two strategies go hand in hand. Now, if you're on the free trial, you just get that fun, simple 3-ticker high risk growth. The second you upgrade, you gain access to the safe growth strategy. All right, big picture, I do think interest rates are going to rise until it creates problems. I do think we're going to see oil keep going up and that your best performing ticker over this cycle will likely be NRGU. But it's overdone in the short term. We're looking for a pullback to help again push Biden's Build Back Better bill through. So watch for governments to coordinate to drive inflation expectations down over the next 3 months. Now, here's our strategy in a snapshot. And what I want you to see is technology is the candlestick black QQQ. That's the NASDAQ. It's highly correlated to Bitcoin. Then we have the energy, and we call technology growth. Then we have energy, which we call value. And then in yellow, we have interest rates. Now, the last time they passed some big spending was it was about a year ago. We had Biden pass 2 trillion stimulus and Trump $1 trillion in December, right before he lost the election. And guess what? At first, we had energy and growth go up together. But you got the bond vigilantes causing another outrageous sell-off in bonds that was way, way, way early, getting the wagon before the horses. And you see the yellow line, interest rates went skyrocketing up. And what happened? Tech stocks and crypto crashed while your energy went up. So that's our strategy in a nutshell. We protect our tech position long-term with the interest rate hedge, which are energy stocks. We protect our energy stocks with UVXY. If we're going to have a gigantic stock crash, guarantee you oil will lead the descent lower, and it's not. So that's our strategy in a nutshell, and it works extremely well. Right now, we're overweight growth, expecting interest rates to fall. That this bond crash is overdone and way, way, way ahead of itself, right in front of a slowdown that's dead ahead. So keep in mind, there's only 3 spots available per day at special pricing, and you can get that special price by calling Dean right now at 505-322-7515. All right, very good. I'm going to jump into the data, and then we'll look at the news and review asset allocation. Okay, so here's what's important. the reverse repo is still at $1.6 trillion. This is the quantitative easing buffering that's going to predict when interest rates are really at a risk of uh, rising for a long period of time. Okay, it's just not happening. It's still elevated at $1.6 trillion. So no risk to the front end of the yield curve, most likely going beyond where it is today. And that 2-year went right up to 1%. I expect it will go no higher than 1.25, which would signal 5 rate hikes. Meanwhile, are we worried about lockdowns? We've been looking at the data saying there will be no lockdown. And so far, that has proven to be the case. So we remain long our energy play. All right, so we did see NRGU go parabolic and our clients took a big profit. It's gone up a little bit higher and we've looked for a better value play to protect against further inflation for the next 3 months. And I do expect oil to go up and for us to take a profit towards the end of February. It's a very volatile asset and you can see it's highly correlated to oil, but more volatile, and it doesn't necessarily go up at the exact same days. And so here we have these overlaid, and what you can see is the expectation for oil to catch up to the inflation we're seeing in oil, copper, and other energy products. And again, this is a beautiful setup. It's there to protect your growth position. Okay, we would never just go long oil without the growth position with a 2-to-1 ratio. Okay, in this chart, we're looking at the most recent data on interest rates, tech, and energy. And so the most recent trend has been, let me zoom in on this. We saw this sudden interest rate hike of about 16%, and much of that has occurred from, zoom in at the bottom, from the 29th of December. So at about 30 trading days, the triple T is up 16%. And what do you see? Just like magic, NRGU is up 56% and the NASDAQ is down 8. We're expecting a reversal to occur in the near term. And I expect that to likely begin by March. This chart, we are now looking at a position in our safe growth strategy, our largest position, which is emerging markets, as the US is going to have a hard time passing aggressive fiscal relative to the previous 2 years. We're seeing China, which has been very, very prudent with its budget, is getting ready to turn on the printing press, expand credit, and save their real estate market. So I expect emerging market to greatly outperform, and to signal that we did want to see FXI and MCHI catching up to the index, because that's where all the pain has been. FXI and MCHI are 2 Chinese specific indexes. So this is starting to play out and we're seeing it bottom out after a year of decline. Also, emerging markets tends to do well with rising interest rates, which is the general theme we see coming forward. Next chart, we're looking at the Russell 2000, and this little puppy is below a critical level. I do expect it will bounce back up. This is problematic and definitely the most bearish signal we have right now. It's compromised of perhaps some pretty junky stocks. Okay, we've got like GameStop and AMC playing all kinds of funny games with the Reddit crowd, short squeezing hedge funds. So it's been fun to watch. It's been volatile. And again, usually this would go up with interest rates going up, but the rate shock did create systemic selling. I expect the rates to come back down and for Russell 2000 to get back into its trading range. Most likely the Russell 2000 breaks to a new high after they pass new stimulus in the US. I do not expect this to sell off further, and it's now a key indicator to focus on. Okay, and again, with Emerging markets doing fine. I believe this is a false signal to get scared about, but we do have it on our, of course, watch list currently. Okay, European stocks remaining strong, and again, most likely needs US fiscal support to break to new highs. In general, with this index trading flat with rates falling, that's a bullish signal. The European index likes interest rates rising. All right, here's our DXY. This is the dollar index. In terms of a major pivot in our portfolio, I'm looking for DXY to fall to 90. At that point, we're going to want to pull some massive profits on our energy and Ethereum position and look at potentially buying bonds in the dollar. Okay, and so I think that is a long ways away and a lot of profits for us as we slowly but surely hit that level. Meanwhile, we were seeing a huge bid in the dollar due to the Turkish lira crashing for most of the year. They lost half of their purchasing power in 6 months. Then the government decided to guarantee forex losses and stabilize the currency. So that was a similar warning, canary in the coal mine, like the Russell 2000. We're not playing the Russell 2000 nor the Turkish lira. We simply look at it to predict problems before they occur. Okay, is China collapsing and they're going to take down the global markets? Well, their currency is really strong, so I don't buy that. And if we jump over to this data, imports are the second highest print in their history, showing that China is doing just fine, and their exports leaped to $3.4 trillion. So total bullshit that China is going to crash the global economy. They are red hot. You want to go long emerging markets as the US is going to have to slow down spending and tighten financial conditions while China does the exact opposite. And in our safe growth strategy, you have a huge position in emerging markets. Okay, in this chart, we're looking at the lumber futures and natural gas prices. Lumber futures have been predicting energy prices in a month or two in advance. So we've got oil predicting higher prices, copper futures predicting higher prices, and lumber futures. So I do believe your play in Boyle is going to play out in spades. Big gains ahead in Boyle. I know everybody doesn't like the volatility in it. They sure didn't like the volatility in NRGU. Boy, if I could just screenshot all the moaning about holding NRGU until it rocket shipped up. Um, uh, so yeah, I predict that you're going to be very happy campers on that front. All right, in this chart, we're looking at some tech giants that have held up the entire US stock market. So while most of the NASDAQ is down 50%, while most of ARK funds are down over 50, some of them down 80%, who are the champions keeping this stock market alive? And so, namely, we're focused on Amazon, Google, Microsoft, Apple, Nvidia, and Tesla. Now, the bonds definitely wreaked havoc on these guys. So I'll pull that up. You can see there's a direct inverse correlation. As rates went up, tech went down. Now, do we think rates are going higher? No, we're headed to a global slowdown right now. This is absolutely certain. So I expect rates to fall and the bid to come right back. So we're not freaking out about our tech positions. Okay, meanwhile, where has some money been rotating? We've been looking at names: Bank of America, Johnson & Johnson, United Health, Home Depot, JP Morgan. Even they got beat up by the interest rate spike. In general, we have been seeing money flow into these names out of tech giants, which are also leaders in the S&P 500. So it's going to be a slow motion growth to value rotation over this 5 years. And it's going to be fun playing the waves back and forth. Okay, over in Asia, we're focused on Taiwan Semiconductors, perhaps the most important company in the world, maybe the cause of World War III in our lifetime. Not expecting that anytime soon. We're looking at Tencent, the software giant out of China, and we're looking at Alibaba, the Amazon of China. And they're all stabilizing. This is looking very, very bullish, and they're starting to get that nice bid. For Europe, I've nailed it down to just tracking Toyota Motors. If this company starts to fall off a cliff, that'll be a warning sign, and it's not. It's at new highs. So literally, the only troublesome data print we have right now are the change of interest rates are alarming, but I believe that is overdone. And the Russell 2000 has broken below a key moving average. Other than that, everything is telling us bullish, bullish, bullish. Now, for NRGU, which we'll be back into in the next significant pullback, we need to focus on technical analysis of Exxon and not NRGU. So leveraged products can be misleading. If you want to predict relative strength and weakness, look at the Fibonacci levels on Exxon. Okay, we have broken way past that Fibonacci level, and I am expecting in the short term a pullback in Exxon and the price of oil. And again, most likely around March. All right, in this chart, we have interest rates and the price of oil, and sometimes they diverge. We can see if we zoom back to April as a starting point. In May, we had oil going up with rates going lower. And I believe that the rates would catch up to oil. That's been achieved. Now we got to ask ourselves, is oil going straight up? Is labor recovering rapidly? And is more fiscal support on the way? Or is the exact opposite here? Slow labor growth, slowing down inflation data, and no fiscal support for months. As far as a new buying opportunity, let's look at these recent lows. I'm going to remove the rates and switch to price levels. The recent lows have been around 62, 66. I'm not going to be so greedy to get us back into NRGU. If we break below 76, we'll probably start to rebuild into our oil position and get aggressive if we're lucky for it to hit 70. All right, here's the copper futures. So it's been trading flat. It had a little bit of a breakout. And again, the interest rates have been predicting this, as well as the gold to copper ratio, which we'll look at. In general, this has been in an uptrend and looks like it's getting ready to break higher with China demand as they get more and more aggressive with stabilizing their real estate market. Okay, this is a bearish signal on the inflation data. The Baltic Dry Index has been falling since October. Now, the cost to ship goods to the US from China continues to hit new highs. So, commodity shipping between continents has been falling, while the cost to ship consumer goods to the US has not slowed down yet. So, two different reads on that data. But again, this is telling me we're likely nearing peak inflation. All right, so here's your 2-year, 10-year, and 30-year, all ramping up since the beginning of December. And this is why everybody thinks we're going to have 4 rate hikes. I'm going to go ahead and look at the absolute level on the 2-year. And the 2-year just about exactly controls the federal funds rate. It's now at 1%. That means it's pricing in 4 rate hikes. I think that's all it's got in it. At most 1.25, and in extreme measure 1.5 is the highest level I believe the 2-year will go until we pass more stimulus. Okay, so this is where all the pain has been coming from. Bonds selling off, demanding more money flow into these assets as the money's taken out of competing assets, which would be your growth assets, tech and crypto specifically. And boy, oh boy, that's exactly what's happened. So do we think the 2-year is going to go higher, or is it done for the time being? And again, I believe the highest it could go is 1.5 in the short term, but I'd be surprised if it goes much higher than 1. And that's again because the data is all slowing down. All right, this is the yield spread between the 10-year and the 2-year, showing that it's been flattening. So we've got the 2-year rising at a faster rate than the 10-year. And this is a very bearish signal that tells us that likely too many rate hikes would create a collapse in the economy. So far it's not inverted, but it's certainly been flattening. This chart's looking at the 30-year and 5-year. And again, it's also been flattening. So all signs are telling us that the Fed should not go too crazy with rate hikes. Otherwise, they're going to crash the economy. All right, these are the 3 core bond markets we track: TLT, LQD, and JNK. All have been selling off. So we can see that the not a big crash, but a little bit. We got the junk bonds down 2.6% since last August. We've seen a lot of volatility in the US government market, up and down and up and down. It can't make up its mind. But again, the main thing that's happening right now is the support from the Federal Reserve is going to be removed in March. So that's likely going to allow interest rates to slowly rise as the economy recovers. And again, our base prediction over a 5-year time span is that rates will rise and there'll be a growth to value rotation. But we just hit a massive gain on the value play and we're expecting a reversion. All right, this chart is comparing Tesla to Ethereum, expecting that one or the other is predicting the future path. And again, if we believe interest rates are going to fall from here, that inflation will peak out by March, and that the government's not going to shut down, then we want to be long the growth assets. And so we can see Tesla signaling Ethereum should catch up to Tesla. We're currently not playing gold or silver, but I like to follow those. And so we can see silver is catching up to gold. Now, a lot of people were commenting on the gold to silver ratio being way out of whack, and it just closed that gap quickly right here. So Peter Schiff is very excited right now if you follow his podcast. All right, these are our deflationary assets. And I was tempted to give us some bond exposure, but I think you're going to make way more money on the growth assets right now. Because again, still probably another 35 to maybe as high as a 50% correction in the TLT before I would go super aggressive long-term into bonds. In the short term, if you give me DXY at 90, I will put you into EUO, a bet of the dollar against the euro, and back into treasuries. But we're a long ways away from that, sitting at 96 on DXY. The only hedge that makes a whole lot of sense is UVXY. If we're going to have a big crash, you can make over 1,000% with UVXY. So if you got 10% of your portfolio in it, you have nothing to worry. Okay, some other plays I am tracking are TAN solar panel. Nothing exciting there. It's been getting crushed, down 20% since December. This could be a good buy in soon. Still haven't made that play that would fit in our high risk strategy. We are long uranium and rare earth metals in the safe growth strategy. We're long oil in both portfolios as the cheap energy play in case inflation keeps running hot for another 3 months, which is the longest period I believe the inflation can continue to creep up on us. And then we're not in copper, but boy, oh boy, is copper getting a nice bid, up 11% with COPEX. In the crypto world, we're looking at the top players. The biggest player by far is Bitcoin with twice the market cap of Ethereum. I believe Ethereum's going to overtake the market cap of Bitcoin and hit a price of $12,000. That will be a heck of a move, and we're really excited for it. It just does so much more than Bitcoin does. And with a lot of its upgrades, it's actually just as deflationary as Bitcoin. The difference is there's a massive, massive financial system built on Ethereum that's alive, vibrant, and funding billions and billions of loans and all sorts of exciting things. And that's why US banks, insurance companies, and broker dealers are doing everything they can to cut people out of this asset. And because of that, if you take the effort to get the exposure, you're patient, it's a hell of a growth asset. Okay, we've got on the competition side the Binance coin, the most liquid exchange in the world. Next, we have Cardano, crept back up above Solana. Cardano is more similar to Bitcoin in its structure of how many coins there can be, but yet it has proof of stake, which Ethereum's switching over to. We've got Solana, which has had a lot of critique as of lately. They've had to reboot the network and reset things, which is not supposed to be possible with a decentralized blockchain, but yet it's owned by super powerful people out of San Francisco. So a lot of money behind it. Ripple's still hanging in there. This is under an SEC investigation. Out of Asia, we've got Luna having a lot of growth, lots of developments. And then Polkadot, another programmer from Ethereum, still hanging in there. Meanwhile, Dogecoin in 11th spot, Avalanche in 12th. And then my next favorite play is Polygon, which is a layer 2 solution for Ethereum. Now, we live in a world where the big players gobble up the little players, and it's questionable what competitive advantage Cardano, Solana, and a lot of these other proof of stake blockchains are going to have soon as Ethereum makes the switch. And it looks like it's going to go live this summer. So a lot of good catalysts coming in for Ethereum. Okay, gold to copper ratio. If we're going to have a long-term recovery fueled by lots of debt growth and suppressed interest rates, it's a perfect setup for interest rates to rise and for copper to outperform gold. This period from 2002 to 2006 is what I'm expecting to play out in this cycle. This is the CME Group's probability for Fed rate hikes. And it's almost a certainty, 91%, that we'll have our first rate hike in March. We've got some people like Bill Ackman coming out saying, hey, let's jump to 50 right away. Right now, the probability of that is only at 5%. But this is already baked in. So unless it's anything different than a 25 basis point hike in March, market's likely to have very little response. All right, in this chart, we're looking at the yield curve over time. And so here's what it looks like. It's got the wrong curve. Okay, so we're inverted on the 20 and 30 year, which is just weird. And it's sloping like a hill. They want it to slant like a ramp. Okay, so that's what we're gonna hopefully see occur. Otherwise, if this inverts on the 2 and 10, likely headed to a recession. So it's trying to invert, hasn't done it yet. We'll see what these moves by central bankers does to the yield curve. Just to see what a good yield curve looks like. Funny enough, right before Trump passed the new spending package, you had a good yield curve. So we really didn't need to go spend all that money, which is what messed up everything. That's what these guys want the yield curve to look like. And so you can see it's the opposite. Okay, we play the VIX, so we like to look at the VIX futures term structure. And we're most interested in where the dots jump the most. Right now, the greatest hedging is occurring in January, February. Lots of uncertainty about whether or not inflation is going to slow down and peak. and whether or not the government's going to pass more fiscal stimulus. And these are critical to the markets. So we're covering that again every Monday, Wednesday, Friday. All right, just taking a look at some of the recent returns in some of the hot cryptos. We can see Cardano down 7%, Binance down 14, DOT down 16, Bitcoin 17, Polygon 21, Ethereum 23, AVAX 27, Solana 29. Buy the dip, buy Ethereum, buy Polygon. Those are my favorite plays. I like Bitcoin and our safe growth strategy, but for high risk, I can tell you it's Ethereum and its partner in crime Polygon are my two favorites. We need to see what impact they're going to have on the competition once they switch to proof of stake and remove their advantage. Okay, looks like the new variant is dying down as anticipated. Okay, we're seeing it in the UK, South Africa, and it looks like the US is topping out here. So I expect this to flatline by probably mid-February. And that's likely when we're going to start seeing jobs come back online. We're going to have the Fed revising its inflation expectations, CPI starting to slow down, and maybe they pass that budget in March or April. Here's the rate of change of cases falling. We did predict it would hit records and that it would be short-lived. And there it is. Okay, this is where we track debt issuance, but if reverse repos at 1.6 trillion, let Janet Yellen sell all the debt she likes. Producer prices perhaps have topped out. We can see it hit 9.8 and fell to 9.7. So this is important. We really don't want to see this go to 10, 11, or 12 in the coming months, as this typically leads inflation. Okay, lots of opportunity for jobs to come online. Again, I'm telling you that's a risk to markets if jobs come back online. But the latest non-farm payroll is only 199,000 jobs. To really recover the economy and support rate hikes, we need to see at least 500,000 jobs a month. But people don't want to go back to work. Now, one sticky inflation data is that wages are rising. So we will see what the balance is of the input costs on producer prices likely topping out as we see the wage and rent pressure coming in. So we will just have to wait and see how this plays out on the CPI. Here's the CPI hitting 5.5. Again, my expectation is it tops out in March. Remember, that's the 2-year anniversary of the lockdown. That's likely where we're going to see the greatest level of CPI jumps. And then after April, all the data is going to rapidly fall based on the change from, again, look at March to April. You can see that huge jump. Jobless claims are rising. Labor force participation is stubborn and flat. We're short 4 million jobs pre-lockdown. Bank credit's growing and a big jump. Consumer credit continues to grow. Here's another sign that growth is slowing. Retail dropped 1.9%. Consumer spending did hit a record high despite the drop. The deficits are massive. That weakens the dollar. Income and wages are rising. China's PMI is starting to come back up. Again, they were in negative territory. They were crashing parts of their economy on purpose to pop bubbles because they want to have a freely traded currency and a thriving bond market so they can borrow lots of money, become the leader. But they got to get rid of the bad debt before they can do that. We already looked at Chinese imports and exports combined. That is $6 trillion flowing through the Chinese economy. Nothing else in the world comes even close to that. Fed's balance sheet just hit a new high. They're still printing money. Europe's still printing money. Japan's been flat since this last summer. If we head over to the news, England's ending all the mandates. Top banks investing in crypto. We've got everybody from BNY Mellon, Citibank, UBS, BNB Paribas, Morgan Stanley, JP Morgan, Goldman Sachs, Nomura, Barclays, all the big cutting edge banks, they see what's happening. They're buying into crypto aggressively. Wage pressure coming into JP Morgan, big raises, about 10% wage growth. Gary Gensler is going after crypto folks, and he says their target is exchanges. So we're following that. There's some information, there's some legislature in the infrastructure bill that's concerning relative to DeFi exchanges. So keeping a close eye on that. So far, everyone's ignoring it. Looks like the inflation is dying down in Brazil, which is a very good leading indicator to follow. Google considering letting its users store crypto in digital cards, hires a PayPal veteran to oversee payments division. Google's president of commerce says crypto is something we pay a lot of attention to. Someone making fun of Kathy Wood saying demand for oil will peak in 2019. I guess she didn't know the lockdowns were going to come and all the money printing. So won't give her too hard of a time. Massive sell-off in the high yield junk bond ETF. Again, typically after that, you get a big buy right after. Let's see, Biden's having some speech right now. And one of my favorite managers, Jeffrey Gundlach, had an interesting comment. We'll find on that in a moment. But they got to drive the price of oil down. It's a political problem. Negative debt just hit 10 trillion from a peak of 18 trillion. Again, this is the pain we've been seeing in tech companies. This chart is looking at predicting, where is his picture? Okay, Zero Hedge says, so the more tech stocks crash, the more money piles into commodities and energy, sending gasoline higher, leading to more angry calls from Biden to Powell, leading to more job owning, more selling of tech stocks. So yeah, the whole point of talking about hiking rates was to try to cool off inflation. And instead, they're causing speculation in energy stocks. This is all extremely overdone. Why we took profits. We're playing a safer energy play. Just in case this plays out for another 3 months. But in general, I'm expecting inflation to peak, yields to fall, and for your tech positions to thrive in the short term. This chart's looking at how high that 2-year yield could go. And again, the trend is that as debt grows globally, the markets become more and more sensitive to rates rising. And every time they go too high, it creates a crash. We can see these crashes in 1990, the dot-com bubble, the housing bubble, the lockdown. And so how high will it go max this round? To look at the highest prints, we went from in the 90s, a 10% yield. Can you imagine that? 2000, a 6.5, 2008, a 5. 2019, it barely touched 3. So how high can it go this cycle? I believe this cycle, the highest it will go is 2. And in the short term, the highest it could possibly go is 1.25 to 1.5. But I think we're probably already at the peak. Okay, Jim Bianco's pointing out that the rates have priced in what's expected now. So unless there's a surprise, likely markets aren't going to get so crazy about these expected rate hikes coming in. And again, more likely they may slow down the rate hike as the inflation data starts to peter out. Here's Kathy Wood's portfolio, just wow, just insane. 88% loss on Berkeley Lights, 81% loss on Invite Corp. Just a bloodbath over there. Record case per 100,000 in Israel, the 4-time boosted country. Okay, go to Nigeria, where the only 2% of the population has it, and there's essentially nothing. So what's going on? I'm still curious. Jeffrey Gundlach says the 2-year US Treasury yield has been pounding higher, now over 1%, but the CPI is 7%. Is a little over 1% an appropriate 2-year US Treasury yield? Now, to be clear, he believes you should be buying bonds with a 25% position in his most recent webcast total return webinar, which is very, very popular, happens twice a year. And he believes that the quantitative tightening is going to drive yields and slow the economy once it begins. So I'm essentially worried about rates rising till about April. We're hedging against that risk with Boyle, and then I expect yields to fall. But the moves already happened, and I'm expecting we may already be very close to peak interest rates. Okay, some talk about a 50 basis point hike to set the market straight, according to Bill Ackman. They tried to do this in the dot-com bust. And again, this was in the middle of the tech crash. Edward Harrison says, when you look at real and nominal yields rising and long duration equities cratering, it shows you the power of forward guidance. The Fed hasn't even raised rates yet. And look what has happened. It has ramped up the hawkish rhetoric. Now, again, unless we think the inflation is going to surprise to the upside from here, the pain is already priced in. I'm expecting that's going to surprise to the downside. Okay, Jeffrey Gunlike says, if the president's news conference tomorrow is mostly about V's, masks, voting rights, and identity politics, he is done. This guy's been a character, usually stays out of politics. So I think he's saying he should be talking about the inflation, monetary policy, and interest rates. So I'll catch that after this webinar. I believe it's live right now. Okay, meanwhile, Peter Schiff, having a fun time making fun of Bitcoin, says the Grayscale Bitcoin Trust is now at a record 27% discount to NAV. Viewers who got suckered into buying GBTC based on a massive advertising blitz and nonstop biased coverage are getting killed, with some down over 50%. So we're actually recommending to buy exactly that, Bitcoin at a 27% discount. Okay, this Grayscale Trust has a trend of having greater drawdown on the downside, but better performance on the upside. So you can quite literally buy Bitcoin at a 27% discount with GBTC. We've got a decent position in our safe growth strategy, and the same is true for ETHE. You can outperform Ethereum to the upside with the discount window. Okay, Elon Musk says we should be worried about population collapse. And that's really the general theme of the globe, is that too few kids to support everyone heading into retirement. Very deflationary, and why we're likely to see rates go lower and the money printing never end. And again, very bullish for technology, for crypto. And we're just going to have to worry about short periods of inflationary bursts, hedging that with our favorite energy products. Okay, great. So very good. I'm going to go ahead and get ready to review our portfolios. But again, if you're on a free trial, you're going to miss out on the exact asset allocations and the trade alerts. This is where your video ends and paid members get to continue. So call Dean at 505-322-7515 to upgrade your free trial right now. All right, guys, let's go ahead and hop into the good stuff.